Welcome students to the series of lectures for the course Corporate Law. Well, today we'll be discussing the topic book building mechanism. The learning outcomes. After completion of this topic, student will be able to understand the book building concept, book building process, benefits of book building, methods of book building versus fixed price method, book building and reverse book building. What is book building? Book building is a price discovery mechanism that's used in the stock markets while pricing securities for the first time. When shares are being offered for sale in an IPO, the pricing of the shares is fixed by the company. However, if the company is not sure about the exact price at which to market its shares, it can decide a price range instead of an exact figure. This process of discovering the price by providing the investors with a price range and then asking them to bid on it is called the book building process. It is considered to be one of the most efficient mechanisms of pricing securities in the primary market. This is the preferred method which is recommended by all major stock exchanges and as a result is followed in all major developed countries in the world. Book building in India. The introduction of book building in India was done in 1995 following the recommendations of an expert committee appointed by SEBI under Y.H. Melligam. The committee recommended and SEBI accepted in November 1995 that the book building route should be open to issuer companies, subject to certain terms and conditions. In January 2000, SEBI came out with a compendium of guidelines, circulars and instructions to merchant bankers relating to issue of capital, including those on the book building mechanism. Book building process. The detailed process of book building is as follows. Appointment of investment banker. The first step starts with appointing the lead investment banker. The lead investment banker conducts due diligence. They propose the size of the capital issue that must be conducted by the company. Then they also propose a price band for the shares to be sold. If the management agrees with the propositions of the investment banker, the prospectus is issued with the price range as suggested by the investment banker. The lower end of the price range is known as the floor price, whereas the higher end is known as the ceiling price. The final price at which securities are indeed offered for sale after the entire book building process is called the cutoff price. Collecting bids. Investors in the market are requested to bid to buy the shares. They are requested to bid the number of shares that they are willing to buy at varying price levels. These bids, along with the application money, are supposed to be submitted to the investment bankers. It must be noted that it is not a single investment banker who is engaged in the collection of bids. Rather, the lead investment banker can appoint sub-agents to tap into their network, especially for receiving the bids from a larger group of individuals. Price discovery. Once all the bids have been aggregated by the lead investment banker, they begin the process of price discovery. The final price chosen is simply the weighted average of all the bids that have been received by the investment banker. This price is declared as the cutoff price. For any issue which has received substantial publicity and which is being anticipated by the public, the ceiling price is usually the cutoff price. Publicizing. In the interest of transparency, stock exchanges all over the world require that companies make public the details of the bids that were received by them. It is the lead investment banker's duty to run advertisements containing the details of the bids received for the purchase of shares for a given period of time, let us say a week. The regulators in money markets are also entitled to physically verify the bid applications if they wish to. Settlement. Lastly, the application amount received from the various bidders has to be adjusted and shares have to be allotted. For instance, if a bidder has to bid a lower price than the cutoff price, then a call letter has to be sent asking for the balance money to be paid. On the other hand, if a bidder has bid a higher price than the cutoff price, a refund check needs to be processed for them. The settlement process ensures that only the cutoff amount is collected from the investors in lieu of the shares sold to them. How is the price fixed? All the applications received till the last dates are analyzed and a final offer price known as the cutoff price is arrived at. The final price is the equilibrium price or the highest price at which all the shares on offer can be sold smoothly. If the price quoted by the investor is less than the final price, he will not get allotment. If price quoted by an investor is higher than the final price, the amount in excess of the final price is refunded if he gets allotment. If the allotment is not made, full money is refunded within 15 days after the final allotment is made. If the investor does not get money or allotment in a month's time, he can demand interest at 15% per annum of the money due. How is the price determined? During the IPO period, bids are received from investors at various prices, which are above or equal to the floor price. For example, a company issues 100,000 shares at a price band of 250 to 300. Applications are received as follows. Application for 10,000 shares at 250. Applications for 50,000 shares at 275. Applications for 60,000 shares at 300. After the bid window closes, the final price known as the cutoff price is determined based on the proportion of application received at each price. In the above example, to issue all 100,000, that means 1 lakh shares, minimum price will be 275 because applications for 50,000 and 60,000 shares, a total of 1,10,000 shares were received for or above 275, the company will refund money to those who applied for shares at a bid price below 275. Those who have applied at 300 will also get their refund. Furthermore, against 100,000 shares, that means 1 lakh shares, 1,10,000 shares were applied for. So we had an oversubscription at the cutoff price of 275. Therefore, the company will issue shares in the 10:11 ratio. That means that an investor who has applied for 11 shares will get only 10 shares. Methods of book building. The companies in India are bound to follow to the SEBI's guidelines for book building offers in the following manner. 75% book building process. Under this process, 25% of the issue is to be sold at a fixed price and the balance of 75% through the book building process. To public through book building process. The process specifies that an issuer company may make an issue of securities to the public through prospectus in the following manner. 100% of the net offer to the public through book building process or 75% of the net offer to the public through book building process and 25% of the net offer to the public at a fixed price. Pure auction as an additional book building mechanism. SEBI has decided to introduce an additional method of book building. To start with, for FPOs, in which the issuer would decide on floor price and may mention the floor price in the red herring prospectus. If the floor price is not mentioned in the red herring prospectus, the issuer shall announce the floor price at least 1 working day before the opening of the bid in all newspapers in which the pre-issue advertisement was released. SEBI guidelines for book building. An issuer company proposing to issue capital through book building shall comply within the following: 75% book building process. In an issue of securities to the public through a prospectus, the option for 75% book building shall be available to the issuer company subject to the following: the option of book building shall be available to all body corporate which are otherwise eligible to make an issue of capital to the public. The issuer company shall have an option of either reserving the securities for firm allotment or issuing the securities through book building process. The issue of securities through book building process shall be separately identified or indicated as placement portion category in the prospectus. The securities available to the public shall be separately identified as net offer to the public. The requirement of minimum 25% of securities to be offered to the public shall also be applicable. In case the book building option is availed of, underwriting shall be mandatory to the extent of the net offer to the public. The draft prospectus containing all the information, except the information regarding the price at which the securities are offered, shall be filed with the board. One of the lead merchant bankers to the issue shall be nominated by the issuer company as a book runner, and his name shall be mentioned in the prospectus. The copy of the draft prospectus filed with the board may be circulated by the book runner to the institutional buyers who are eligible for firm allotment and to the intermediaries eligible to act as underwriters, inviting offers for subscribing to the securities. The draft prospectus to be circulated shall indicate the price band within which the securities are being offered for subscription. The underwriters shall aggregate the offers so received for subscribing to the issue and intimate to the book runner the aggregate amount of the orders received by him. The institutional investor shall also forward its orders, if any, to the book runner. On receipt of the information, the book runner and the issuer company shall determine the price at which the security shall be offered to the public. The issue price for the placement portion and offer to the public shall be same. On determination of the price, the underwriter shall enter into an underwriting agreement with the issuer, indicating the number of securities as well as the price at which the underwriter shall subscribe to the securities. On determination of the issue price, within 2 days thereafter, the prospectus shall be filed with the registrar of company. The issuer company shall open 2 different accounts for collection of application monies, one of the private placement portion and the other for the public subscription. 1 day prior to the opening of the issue to the public, book runner shall collect from the institutional buyers and the underwriters the application forms along with the application monies to the extent of the securities proposed to be allotted to them or subscribed by them. Allotments for the private placement portion shall be made on the 2nd day from the closure of the issue. The board shall have the right to inspect all book building records. Now the other one, 100% book building process. In an issue of securities to the public through a prospectus option for 100% book building shall be available to any issuer company subject to the following: issue of capital shall be rupees 25 crores and above. The issuer company shall appoint an eligible merchant banker or bankers as book runner or book runners, there can be many book runners, and their names shall be mentioned in the draft prospectus. The lead merchant banker shall act as a lead book runner, and the other eligible merchant banker or bankers so appointed by the issuer shall be termed as co-book runners. The primary responsibility of building the book shall be that of the lead book runner. The book runners may appoint those intermediaries who are registered with the board and who are permitted to carry on activity as an underwriter, as syndicate members. The draft prospectus containing all the disclosures as laid down in, except that of the price and the number of securities to be offered to the public, shall be filed by the lead merchant banker with the board, provided that the total size of the issue shall be mentioned in the draft prospectus. In case of appointment of more than one lead merchant banker or book runner for book building, the rights, obligations, and responsibilities of each should be delineated. In case of an undersubscription in an issue, the shortfall shall have to be made good by the book runners to the issue, and the same shall be incorporated in the allocation procedure. The board, within 21 days of the receipt of the draft prospectus, may suggest modifications to it. The lead merchant banker shall be responsible for ensuring that the modifications, final observations made by the board are incorporated in the prospectus. The issuer company shall compulsorily offer an additional 10% of the issue size offered to the public through the prospectus. Once the final price, that is the cutoff price, is determined, all those bidders whose bids have been found to be successful, that is at and above the final price or cutoff price, shall become entitled for allotment of securities. No incentive, whether in cash or kind, shall be paid to the investors who have become entitled for allotment of securities. The final prospectus containing all disclosures as per these guidelines, including the price and the number of securities proposed to be issued, shall be filed with the Register of Companies. Procedure for bidding. The method and the process of bidding shall be subject to the following. Bid shall be open for at least 5 days. The advertisement mentioned at clause shall also contain the following. Number 1, the date of opening and closing of the bidding, not less than 5 days. Number 2, the names and addresses of the syndicate members as well as the bidding terminals for accepting the bids. Number 3, the method and process of book building. Bidding shall be permitted only if electronically linked transparent facility is used. Next, the syndicate members shall be present at the bidding center so that at least one electronically linked computer terminal at all the bidding centers is available for the purpose of bidding. The number of bidding centers shall not be less than the number of mandatory collection centers specified in these guidelines. Next, individual as well as institutional investors shall place their bids only through the syndicate members, who shall have the right to vet the bids. Next will be the investors shall have the right to revise their bids. Next, bidding form has to be there. Next, there shall be a standard bidding form to ensure uniformity in bidding and accuracy. Next will be the bidding form shall contain information about the investor, the price, and the number of securities that the investor wishes to bid. Next, the bidding form, before being issued to the bidder, shall be serially numbered at the bidding centers and the date and time stamped. Next has to be the serial number may be system generated or stamped within an automatic numbering machine. The bidding form shall be issued in duplicate, signed by the investor and countersigned by the syndicate member, with one form for the investor and the other for the syndicate member or members or book runners. Next, at the end of each day of bidding period, the demand shall be shown graphically on the terminals for the information of the syndicate members as well as the investors. Allocation or allotment procedure. At least 15% of the issue size shall be reserved for the allocation to individual investors applying through the syndicate member. 10% of the issue size offered to the public through the prospectus shall be reserved for the allocation to the individual investors who had not participated in the bidding process or have not received an intimation for the entitlement of securities. In case of undersubscription, in the category referred to in class 2nd of this class, the issuer company has the option to allocate it to the whichever category it deems fit or let the undersubscribed portion lapse. Benefits of book building. There are many benefits associated with the book building. These are listed briefly as follows. Book building leads to price discovery and help us in finding the intrinsic value of the security being offered. The price of a security is determined in a more realistic way by taking into consideration the demand for security. The issuer gets the maximum price for the security. The issuer company can choose the quality investors. There is a great transparency in the allotment of shares to the investors. Another advantage can be book building process results in lower costs of issue. Especially, book building helps the issuer save a lot of money on advertising and brokerage. Now, there are limitations to the book building process as well. These are, the book building method suffers from the following limitations. The book building process followed in India is quite different than the one followed in USA, wherein road shows are held and the issue prices arrived at a few hours before the issue opens. There is a lack of transparency at the critical steps of book building process and the absence of strong regulation, since the price band fixed for the public portion as well as the placement portion is the same. Issues may not succeed in inviting desired public response. This is a great disadvantage. It has not been proved to be a good price discovery mechanism. Many issues have been listed below their floor price. Issuers may have to sell cheap due to the collective bargaining power of institutions. This is true. This is a great disadvantage. High institutional holding may affect stock's liquidity and may make it volatile in case of bulk offloading. The role of retail investors in determining the pricing decreases as only 25% of the total issue is offered to retail investors. Moreover, the retail investors may not have the information to judge the issue and may not, as such, arrive at the correct pricing, which is a great disadvantage. Most book-built IPOs, that means initial public offerings, since 1999 have fared badly on the stock market. 18 out of 19 are currently trading below their issue price. SEBI needs to relook the entire book building process at the operational level and, if need be, modify its guidelines. Needs to be covered is, how is book building better than the fixed price mechanism? Now we will draw a comparison here. Price discovery can follow two popular mechanisms in an initial public offering. The most commonly used book building IPO or a fixed price issue. Both have their merits and demerits. However, a transparent book building process is most sought after in markets worldwide. In a fixed price issue, the price of the securities is already notified in the prospectus. There is no bidding or aggregating of demand to arrive at the right price. The full amount, including the price of the shares, should be paid while applying for them. The public demand for shares is only disclosed after the conclusion of the offering. Now, as against this, in the book building mechanism, as discussed earlier, the prices are determined by a transparent bidding process, with only the price band disclosed to the investors in the prospectus. In this method, only the application money is to be paid at the time of bidding. The full amount is collected after the issue price has been fixed. The fixed price model is restricted to follow-on issues, rights issues, and ESOPs. ESOPs means employee stock option plans. Whereas the initial public offering almost always uses a transparent book building process. Under fixed pricing, the company also faces significant IPO pricing risks if it fails to realize sufficient demand for the offering based on an arbitrary price, which can be eliminated for most of the part with the book building method. Book building versus reverse book building. Now, this is very important, to be talked about. While book building is used to raise capital for the company's business operations, reverse book building is used for buyback of shares from the market. Reverse book building is also a price discovery method in which the bids are taken from the current investors and the final price is decided on the last day of the offer. Normally, the price fixed in reverse book building exceeds the market price. So, students, with these words, we conclude today's topic on book building mechanism. Thank you very much.